Okay, welcome to this installation of Benchmark International's webinar series. We have an audience joining us from around the world today. Today we're going to be discussing what I like to think is, or what I think is, the most important part of the company sale process, the letter of intent. This is really where we see the most value won or lost by our clients in the process. Of course, a lot of important things happen at the end with the purchase agreement, but they tend to kind of revert to the mean there. You really see some wild stuff in the letter of intent stage. So that's why we wanted to spend an hour today talking about just about letters of intent, and specifically the 12 mistakes that we see sellers making in letters of intent. As always with our webinar series, we have a bar on the right-hand side of your screen. On this, you can do two important things. One, you can submit questions. I have Wade Duncan filling in for Sam today, who will be fielding the questions. He'll collect them throughout the process. He'll maybe reply to some of them immediately, and the ones for the general audience he'll have for us at the end, and we'll have a Q&A session at the end. In addition, you'll see a series of PDFs available for you to take a look at there. Two of those are our magazine, the Benchmark Mark. One is the US edition and one is the UK edition, so feel free to take a look at whichever one is most applicable to you. And some other literature about Benchmark you'll find there. So let's get started with the show today and get right into the 12 mistakes. So an outline of what we're going to cover today. Point number 6 at the bottom is where I want to spend most of the time, but I want to have a level set and make sure that everyone gets as much value as possible out of this webinar. So 1 through 5 I'm going to run through pretty quickly. We'll start off talking about what a letter of intent is and what it is not. Then we'll discuss where that letter of intent fits in the chronology of the transaction. We'll discuss valuation in a very narrow sense of valuation in a letter of intent, not a grandiose discussion of overall valuation. We'll then talk about a few of the terms in the letter of intent that are binding, and we'll wrap up basically the introduction by talking about some items that are sometimes in the letter of intent and sometimes left out of the letter of intent. And again, spend most of our time discussing these 12 common mistakes. So we'll get right to it. What an LOI is and what it is not. So an LOI is slang, and I've been using that a lot, but it stands for letter of intent. Letter of intent has a couple other names. It's also known as a term sheet or heads of terms. A heads of terms is not a common phrase in the United States, but it is in the rest of the Anglophone world. And those terms can be used interchangeably. There's no legal definition of any of those terms. They're just industry lingo that's used. And what we'll be discussing today are the aspects that are common, no matter what you call it, a term sheet, a LOI, or heads of terms. We'll be discussing elements that are common to those pretty much globally, maybe 1 or 2 things about taxation or US specific, but the rest will apply equally, regardless of what you call this document where you live. So what is an LOI? This is a really important little clause here, a summary of the key deal points. So it's not the details of the key deal points, nor is it a summary of all deal points. It is only a summary of the key deal points. So it is very, very much an outline. The typical letter of intent that we see is about 2 to 4 pages when you take away kind of the niceties around it and you actually get to the meat of the LOI. Whereas, to get this deal closed, you're going to have 100, 200 pages of paper and multiple contracts to sign. So you can imagine that the way you get 100, 200 pages down to 2 to 4 pages is by summarizing and only talking about the key deal points. Something that an LOI is not. So an LOI is not an indication of interest or an IOI. So again, it heads of terms, letter of intent, term sheet mean the same thing. IOI or indication of interest is a different thing. An indication of interest doesn't happen on a lot of deals, but when it does happen, it's something that comes before the LOI. And it's unfortunate that IOI and LOI sound a lot alike, leads to some confusion. But an indication of interest will usually be a paragraph long, maybe a page long, and it will tend to discuss the value of the company as a range of numbers, say $20 to $25 million, whereas a letter of intent will typically have one price, say $25 million, and again be 2 to 4, maybe 6, maybe sometimes even 10 pages in length. 10's a bit long, but wouldn't be surprised to see a 6-page LOI. So not an indication of interest. It is also not a purchase agreement. So the purchase agreement will be drafted by lawyers. It will be heavily negotiated. It will go back and forth many times, and it'll be purchase agreements we see tend to be 30 to 60 pages in length, just for the purchase agreement alone. And so you don't have to try to get everything in that 30 to 60 pages into the 2 to 4 pages of the letter of intent. Not at all necessary, and in fact, not a good idea to try to do that. It is not, and this is probably the most important thing that people understand, it is not a binding promise by the business owner to sell the business, nor is it a binding promise by the acquirer to buy the business. And so oftentimes you'll hear these referred to as a non-binding letter of intent or a non-binding term sheet or non-binding heads of terms. They should always be non-binding. We have occasionally had clients that will sign into a binding letter of intent, and by binding they mean that they're obligated to sell and the buyer's obligated to buy. And when we go through the chronology of when the LOI comes up, I think you'll see what a bad idea that is. It's something we always strongly recommend not be done. How can you take all the issues that have to be discussed in a 30 to 60 page purchase agreement plus another 50 pages of definitive agreements, put it into 2 to 4 pages and agree to make it binding? I mean, here in the state of Florida where we live, you can't even sell a house on something less than 12 pages long. So a house is just a tangible asset. It's one location. There are no employees. There's no intellectual property. Selling a house is way easier than selling a business, regardless of the size of the house or the size of the business. It's borders on the ludicrous to think that you can sign a binding letter of intent, cover all the things you need to cover in 2 to 4, even if it's a long letter of intent, 6 to 10 pages. It's not realistic to think that you're going to be able to close a deal based simply on those terms. So non-binding letter of intent. I can't emphasize enough that binding letters of intent are not a good practice. All right, further on what is an LOI? So it's important to remember that as a seller, your highest leverage in the transaction typically becomes right before you sign the letter of intent. The reasons for that will become clear as we move through the webinar today, but we'll discuss a bit in the next slide, one of the key reasons why that's the case. But remember, just before you sign the letter of intent is when you have the most leverage. It doesn't kind of consistently degrade from there. It goes up and down as the deal goes along, but it's typically never as high as the moment before you sign the letter of intent. I think some sellers think the way a letter of intent comes across, they either sign it or don't sign it, but that's not the case. Letters of intent are fully subject to negotiation. They should be negotiated. The seller should be very comfortable with the document before they sign it, even though it's not a binding promise to sell. And so the key point there being, if you have a big ask, get it out before you sign the letter of intent. Suppose that you have a particular objective or requirement that the buyer might consider unorthodox. So suppose you want employment agreements for 5 family members to be put in place as part of the transaction. And if you raise that after the letter of intent is signed, the buyer might see that as a bit untoward. You'll also have a harder time getting that written into the final deal. Whereas if you make it a condition to signing the letter of intent, it's better for all parties involved. So when you are presented with the letter of intent, that's the time to really think, what are the key points that I want to summarize in this letter of intent? And let me not create any surprises for my acquirer after the letter of intent is signed. So what is an LOI? This, as I said, this is part of the reason that you will start to lose leverage as a seller when you sign the letter of intent, because one of the things that you're going to agree to in a letter of intent is to take the company off the market. And while the overall letter of intent is non-binding, this is one of the binding terms. The buyer demands this of the seller because once the letter of intent is signed, the buyer is going to engage attorneys to draft purchase agreements and conduct legal due diligence, as well as other diligence providers to investigate the business. They will also start applying for loans, or otherwise rounding up the capital that they need. Even if it's a operating company that's going to be using money out of their own treasury, they still have to get the money lined up and set aside for this particular purpose. So they're starting to make commitments and outlay a lot of cash. And in exchange for that, they ask that you agree with a binding clause that you will take your company off the market. We typically see buyers spending between the letter of intent and the closing of a transaction between hundreds of thousands of dollars, and we've seen as much as $5 million on a larger deal that the buyer will spend. And so it's a pretty fair ask. Of course, the seller will also be spending money, but the seller tends to spend their money later in the process, closer to the final agreement being signed, as opposed to right after the LOI is signed. And the order of magnitude is different. We typically see sellers' transaction costs during this phase be 1/10 to a quarter of the expenses of the buyer. So it's a very fair ask. It's entirely market. In fact, if we do occasionally see letters of intent come in that don't ask for a binding exclusivity clause, or what's called a no-shop clause. And when we see that, we're a bit suspicious, because experienced buyers know that they can get it every time they ask for it. It's a logical ask, and they really should be asking for it. So I think it's the last slide on what is an LOI and what is not an LOI. The final value to the seller is not set in the letter of intent. It's merely a summary of the enterprise value of the business, or the equity value of the business. If you look back at one of our prior webinars, either one or two webinars back, we discussed all the issues of valuation that need to be discussed after the letter of intent is signed. Probably should have done this webinar before we did that webinar, but this webinar actually arose out of some of the questions we received during that webinar. So we've got them reversed. But if you didn't see that one, I would encourage you to go back and watch that webinar now, so you can more understand this slide, saying that it's just a summary of the value. There are a lot of other aspects of the value that can be unlocked for the seller between the LOI signing and the closing. Lastly, here on the bottom of the slide, you see that unfortunately sometimes sellers think, I've got the LOI signed, it's all a coast from here to closing, and it's actually the opposite. The most strenuous part of the transaction, the most stress, the need for the highest stamina, the largest time commitment, the largest cash outlay for the seller is going to happen after the letter of intent is signed, not before. So you need to really view the signing of the letter of intent as ramping up. Sometimes there's a little kind of a calm before the storm. The letter of intent gets signed, and then there's kind of 2 or 3 days while the seller's getting, or the buyer's getting their diligence teams together and their diligence requests, and it seems very calm, and then it comes roaring right back. We like to try to avoid that. We like to carry on from signing the LOI right into the next steps. But sometimes that lull gets the sellers a little bit too calm, and then they're up for a surprise afterwards. So be advised, it's just starting when you sign the letter of intent. Okay, move on to the next step here. Try to get these a little faster so we can get to the 12 issues. The chronology. Where does the letter of intent fall in the company sale process? So what's happened before the letter of intent? The company has built its marketing strategy, drafted its teaser, its confidential information memorandum. This usually takes a month or two. The company has gone to market. The teasers have gone out, non-disclosure agreements are signed by interested buyers, confidential information memorandums go out. Then the counterparty, or the acquirer signing the letter of intent, or at least offering the letter of intent, has read that confidential information memorandum, and they've done some review of the financial conditions of the business. These buyers tend to always start with the financial condition, 99 times out of 100. And then hopefully, after they have read the confidential information memorandum, they've had some phone calls with the business owner and the acquirers. When we receive a letter of intent before a phone call's even been held, it's very suspicious. In order for the letter of intent to have some good meaning, we really want to get the buyer to the right place in the process. There are some buyers that will just throw in a letter of intent based on what they've read in the information memorandum. That's not really a good letter of intent. You really want to have had some dialogue. In addition to the phone calls, hopefully there will have been a face-to-face meeting, maybe even a site visit of the seller's premises. Now, sometimes it's just not possible to do that before a letter of intent is signed. But again, the farther through the process the buyer gets through these steps I've just shown you, the more meaning that letter of intent really has. Because remember, as a seller, you're agreeing to go off the market, basically kind of throw away all the work that you've done and start afresh with one single potential buyer. And in exchange for giving that up, you want a really good letter of intent, not just in terms of the headline number on the top of it, but you want it to really mean something. You want to have as high a possible probability of closing that transaction. So rushing letters of intent before a face-to-face meeting, we don't think that's such a good idea. And receiving a letter of intent before there's even been a phone dialogue is not a good sign. Okay. So kind of what I said there, the purpose of all that is you want to make sure before you sign a letter of intent with the buyer that they have a good feel, not only for the business, but also for your objectives, right? So this kind of goes back to when I said that your maximum point of leverage is right before you sign the letter of intent. So make sure you get your asks, or at least your key asks, on the table. Your objectives are some of those key asks. So if there hasn't been a discussion about your objectives, how do you want to stay on the business? Are you particularly concerned about the clients or certain employees? Or is there a particular way that you feel about deferred consideration for the transaction? Unless they understand your objectives, the letter of intent might not mean too much. So you want to get those, whether that's through the phone conversations or the face-to-face meetings. They should know your objectives before you sign that letter of intent. Okay, then after the letter of intent, very quickly, just to remind you, that's just a start, not an end, because after the letter of intent is signed, the acquirer will start due diligence. We're seeing on average 5 to 8 different due diligence teams come in. You have lawyers doing legal due diligence, accountants doing what used to be called financial due diligence, but now it's called a quality of earnings. You'll have employment due diligence, benefits due diligence. Those are actually 2 different things to a lot of buyers. You'll have environmental due diligence, again, depending on your industry and your particular business, real estate due diligence, and the list can go on and on, can get very specific. So these diligence teams will start, questions will start to be asked, documents will have to be turned over in addition to the documents that have already been collected. And then shortly thereafter, you'll start the drafting of the definitive agreements. This is the purchase agreement, and then if there's, say, a note attached to the purchase agreement or employment agreements or leases, all these other definitive agreements that will be signed as part of the closing process of the transaction. You'll have your lawyers in at that point working on those documents for you. We like to have that definitive agreement drafting start a little bit after the due diligence. Buyers like to run them sequentially because their lawyers cost a lot of money to be drafting documents. And if they find something in the diligence they don't like, then they've already paid the lawyer for a deal that gets busted. So they try to stretch it out a bit. We try to compact it as much as possible on the sell side. And then, of course, there's a lot of negotiation that goes on additional points. Some of it's negotiation with the attorney on the legal points. Some of it's negotiation with the broker on the financial points. Just tons and tons of negotiation. So all that is going to happen after the letter of intent. I think you have a pretty good idea now of where this falls in the process. Brief discussion of valuation within the letter of intent. Typically the first sentence of a letter of intent, there's a little fluff at the beginning, but the first kind of meaty sentence says, we are offering to buy your business for, and then after that it's worded one of 2 ways. It will either be a fixed price or it will be a multiple of some EBITDA. So it may say we are offering $25 million for your business, or it may say we are offering 7 times the 2018 EBITDA, or 7 times the trailing 12 months EBITDA. There'll be some measurement period, typically 12 months, and a multiple, and those will be put together. And either way is acceptable. Some people think one's better than the other, but it's important to understand which one it is. And sometimes we see letters of intent come in, they're kind of mumbled between the 2, and we really like to kind of pin down what the offer is. Is it A or B, not a hybrid of the 2. So once you get that figured out, is it A or B? The next thing is, you want to look and see what conditions there are on that offer, and some people think, hey, if the buyer doesn't provide any conditions, that's better. Don't bring it up at this stage. And some people think, no, let's have a discussion. And the truth of the matter is, if they don't list any conditions, again, remember, it's not a binding offer. So if they don't list any of their conditions, they can always raise them as conditions down the road. So, there's a school of thought that says it's better to ask what the conditions are, and they're never going to give all the conditions, but at least, 3 or 4 of the key conditions on that offer to get those included. And that way, if they try to retrade the price after finding something in diligence, the seller can go back and say, well, look, there were these 3 or 4 conditions, and this thing you're talking about was not one of the conditions that you mentioned, so why are you trying to change the price? In the absence of any conditions being listed, it kind of gives the buyer a carte blanche to make anything a condition on the offer. So minor point, but like to kind of lay those conditions out right below the headline number that's offered. So what comes right after the headline number and then the conditions on that should be a little bit about the structure of the deal. You're not going to get to the ends of the earth on the details of the structure, but a couple of things that you should know is the structure. We see offers come in and say, we'll pay $25 million for your business in a stock or an asset deal. And then they go into something else, say, well, the tax difference in the United States between a stock deal and an asset deal can be as high as 17%. So it's a pretty big variable to leave open. We really don't like to do that. The buyer, if the offer is serious, the buyer should know whether they're going to offer a stock deal or an asset deal. There are some times where when that comes in over the transom as the first draft, and you inquire with the buyer why they're saying that, there may be some reason that they can spell out, and you can leave that open. There's some ways you can artfully discuss the tax consequences in the letter of intent to make sure the seller is protected. But again, 99 times out of 100, it should say whether it's going to be a stock deal or an asset deal. Again, in the United States, you can do an asset deal, you can do a stock deal and then have a tax election. Which in a tax election, it essentially means that a stock deal will be treated as an asset deal for tax purposes under the U.S. Internal Revenue Code, which is a loss for the seller in almost every case. So we like to be certain that the LOI is a stock deal or an asset deal. And if it's a stock deal, we like to know whether there's going to be a tax election or not a tax election. Because again, the tax election can swing the take home for the seller by as much as 17%. So those are the kind of high level issues that we're talking about in terms of the structure. Another issue on the structure should be how that purchase price is going to be paid. Is it going to be paid in cash? Is it going to be stock of the acquirer? Is part of it going to be in the form of a seller note? Will there be an escrow set up that will be where some of that money will be withheld? Will there be an earnout? So the buyer should map out, say $25 million, how that each dollar of that $25 million is going to be divided up into these different, 4, 5, 6 different ways that consideration is typically provided in an M&A deal. So that's on the structure, right? Because you can see how all these relate to valuation, right? Last thing I want to mention on this is that a good letter of intent should provide the buyer's debt to equity ratio. And the way that this is normally done is a little table called a source of funds, use of funds table. It has 2 columns. The source of funds, which is where all the money is coming from. So our own equity or buyer's equity, and then, debt. And if there's going to be some seller financing, it might say seller note. And it'll line up where all the cash comes from on one side. And on the other side, it will say where it's going to be spent. So it might say buyer's transaction costs, cash to the seller, things like that. And the key is that both sides will have to balance out. The sources and the uses have to balance out. So when they provide that, that's something then the broker can sit with the seller and talk them through what that means. And the main thing that we're looking for there is the debt to equity ratio. So if the seller is going to stay involved in the business, buyers tend to use a lot of debt to buy businesses in the middle markets, and they use much more debt than our clients typically have been using in their business. A lot of our clients will be debt-free, or they'll be debt-free, but they'll use a revolver at certain times of the year and be debt-free at other times of the year. So, we want to, if the seller's staying on, we want to get them very comfortable with the level of debt that's going to be in the business, and particularly if they're going to be rolling over some of their equity, that means retaining some ownership interest. Where that money is coming from matters a lot, because if oftentimes the company itself that's being bought will be the maker of the note to the bank or the obligor on the acquisition debt. And if that's the case, we have to make sure the buyer is not claiming credit for that when they calculate the value of the seller's rollover. So a couple of reasons why that's very important. One more reason that's important is because, we have enough experience when we see the debt figure come in. If it's too high for that particular industry or business, we'll know that the buyer doesn't know what they're doing. That the amounts of debt that can be borrowed are, they change over time, but at any given time, there are some bandwidths that are realistic expectations for the amount of debt the business can carry when it comes to borrowing from acquisition lenders, I meant to say there. So a lot of reasons why you want that debt to equity ratio in the letter of intent. Okay, last thing I want to discuss before we get into the meat of it is, there's two more things, binding terms. So as I mentioned, the exclusivity clause is binding. It's called a no-shop clause. In other words, you won't take their offer and shop it around town trying to get someone to beat it by 2% or 5%. So exclusivity, you won't market the other buyer approaches you with an offer, you have to tell this acquirer. And this, of course, has a finite time period. We used to really push to get these down to 60 to 90 days, but the reality of today's market, with the amount of diligence that's being done, it just takes longer. So this exclusivity period will typically be 90 to 120 days. If a letter of intent comes in asking for more than 120 days, that's a warning sign. That's something that should be discussed with the buyer. A good buyer should be able to close the deal within 120 days of the letter of intent being signed. Confidentiality, also a binding clause. So again, they don't want you telling other people what type of offers they're making. This confidentiality should be mutual. Of course, the buyer will have already signed a confidentiality agreement in order to see your information memorandum, but those confidentiality agreements are a bit weaker than what you would ask for here. Those, buyers won't give away the family jewels just to read an information memorandum. So by necessity, they have to be a bit weaker. Now you're getting ready to show them the family jewels. So now they should be willing to stick their neck out a bit further and agree that to a stronger form of confidentiality. So there should be a good, strong mutual confidentiality binding clause in that letter of intent. Expenses should also be binding. Everybody should pay their own expenses. At times, we're able to get the buyer to pay some of the seller's expenses. We think it's a really bad idea for the seller to pay any of the buyer's expenses. We fight very hard to ensure that never ends up in a signed LOI for our clients. It's just not a good idea. You need, as a seller, a level of commitment from the buyer that they're going to spend some money. You're going off the market for them. They need to have that level of commitment. They're spending their money. You do not need to be covering their expenses, not even in part. And of course, choice of law, right? If these binding clauses become an issue, you need to know what law governs them. So there should be a choice of law. But that's really it. Those are the 4 or 5 clauses that are binding in a letter of intent. All right, last section before we get to the good stuff. What's in a letter of intent? What's out of a letter of intent? And these are on the list here because they can go in or they can stay out. There's really no rule for these. They're just considerations that you should have when you're looking at a letter of intent. The post-closing employment terms. Most times, the sellers are staying on either for a 3 or 6 month transition period or on a longer term basis, a 3-year contract, a 5-year contract. And do you want to discuss those in the letter of intent, or do you want to leave those to be dealt with later? Case by case basis, we would make different recommendations to different clients. Just bring it up as a consideration here. Real estate terms, oftentimes our clients have affiliate owned real estate from which their businesses operate. And in those cases, some of our clients have a strong view that they want to sell the real estate or that they don't want to sell it and they prefer the recurring income stream from leasing it to the business in the hands of the new owner. So do you want to discuss those in the letter of intent, or do you not want to discuss those in the letter of intent? Again, case by case basis. Net working capital rules. Net working capital is, again, the subject of a whole another webinar. But sometimes buyers try to cram a lot of net working capital language into letters of intent. And in reality, when you don't know when the closing date is going to happen, you can't really set the net working capital rules because most businesses are cyclical. Their current assets and current liabilities go up and down throughout the year. So it might be realistic to have the net working capital be at a certain position in September, but totally different if the deal closes in November. So it's not a no-no to discuss net working capital in the letter of intent, but we really don't like to see the buyers trying to push that too far unless they have a very firm closing date, which is very, very hard for them to do. Escrow, again, might be in, might be out. Oftentimes buyers will say, they'll talk about the structure, they might talk about notes, they might talk about earnouts, they might talk about rollover, but they won't say anything about escrow in the letter of intent. Then when the purchase agreement arrives, surprise, surprise, in addition to the note and the earnout and the rollover, there's also an escrow that's coming out of what they said in the letter of intent was cash at close. And the buyer's position is, there's always an escrow in these things for your indemnifications. Well, that's kind of true, but it's also kind of true that if the LOI was, a half a page long, you probably wouldn't mention the escrow there, but a 4-page LOI, if you were going to ask for an escrow, you should have put it in the letter of intent. And so it's kind of tough from the sell side. You don't really want to ask the buyer during the letter of intent stage, hey, if you're going to ask for an escrow, please put it in the letter of intent, because the answer you're always going to get is, yes, I'd like an escrow. Thank you for reminding me. So it's a little bit hard for the seller to dance there, but it's borderline foul play if the buyer doesn't put it in the letter of intent and then asks for it later. Unfortunately, it's only borderline, so buyers do try to get away with that surprise. And I said a surprise, something I meant to mention earlier, right? Because so much of the letter of intent is not binding, it's, aside from those 4 or 5 clauses I mentioned, it's not really a contract. It's not about creating legal rights for either party. A letter of intent's real value is in creating expectations. So when you're trying to decide what to put in or what to take out, what to ask for before you sign it, what level of detail to get into in the structure, all these things I've been talking about, it's really about how do you want to set the expectations? If you're a person who will risk losing a buyer right before an LOI is signed, but only wants to go through the process from LOI to closing once, you're going to want a little bit more detail. You're going to want to discuss a few more of these points. You're going to want a longer letter of intent. If you're someone else that, is willing to kind of roll with a little bit more, don't want to turn off a buyer that's made a great offer in that first line of the letter of intent, you go for a shorter LOI and you work these things out later. Every client's unique, and the broker works with the client to see what their appetite is. But we've pretty much gone through the full range of those types of issues and levels of detail at this point. Skip that one. And the last thing to talk about here is the timing expectation. So as I mentioned earlier, the no shop kind of sets the timing expectation and it should be 90 to 120 days should be how much time you're giving the buyer exclusivity. But it's also important to set out some other timing expectations in there. So when are you going to start the diligence? When are you going to give me a first draft of the agreements? When I turn a document back to you, how many days should I wait to get a turn back from you? When are we going to have our on-site meetings? How do you as a buyer go through this process in terms of timing? Do you do this sequentially or do you do it simultaneously? So these timing expectations are an important thing for the seller to ask of the buyer as well. Okay, that's the introduction. So now hopefully everyone's we got a level set there. Everyone's thinking the same thing when I talk about letters of intent, and I've gone through some of the philosophy of letters of intent and the facts. And now let's get into the meat of this thing for the last half of it, the mistakes. All right, 12 mistakes we're going to go through. The first one, the no shop clause. I've talked about it a lot. You want to have some outs in the no shop clause. If you just sign a letter of intent that says, no matter what, I won't shop the business for 120 days, and the buyer just loses interest after 2 weeks, or the buyer comes in after 3 weeks and says, I have to adjust the purchase price downward because I found something in diligence. You made a mathematical error in computing your EBITDA, and so therefore I can't pay as much. I'll still pay 7 times, but your EBITDA is lower, so the purchase price is lower. Are you still locked into the no shop or not? Well, the way the buyers write the no shop clause, they don't offer a lot of outs. They, in fact, don't offer any outs to the seller. We like to build into our letters of intent certain outs where the no shop can, or in fact, the entire letter of intent can be brought to a halt. These include things such as retrading the price or retrading any of the terms spelled out in the letter of intent. It includes an extensive period of inactivity. from the buyer. If the buyer just isn't showing interest for a couple of years, you went through this whole process, all these things we discussed that you did before the LOI was signed. There's a lot of effort and a lot of money you spent on that. You did those for a reason. You did it because you want to sell the business. So is it really fair to have a buyer come in and go silent on you for 2 or 3 weeks after you have this sunk cost and you have this stated expectation that you want to exit the business? No, it's not fair. So we like to build in these escape hatches from the no shop clause. That's our number one mistake. And these are in no particular order. I think there was some order when we created these, but it's not like most common to least common or most important to less important. They're all important, and they all happen. So, all right. Second mistake, the no shop period is too long. I touched on this earlier. A good buyer shouldn't need more than 120 days. If they ask for that, that means they probably think they're going to have trouble raising the money. And people that have trouble raising the money often have trouble raising the money, and the deals don't get closed. So if the initial LOI comes over to you and it's asking for 180 days of exclusivity, and you go back to the buyer and say, I'm not going to give you more than 120. You should only need 90, but I'll give you 120. And they say, okay, they probably still need the 180 days. So they'll agree to the 120, and what their hope will be is that you'll fall in love with them over those 4 months. And when the expiration comes up and they haven't raised the money yet, then they'll sweet talk you into extending it and extending it and extending it. And to be honest, that works sometimes. Sometimes there are buyers that can get the money, they just can't get it quickly. So sometimes extensions are warranted. Sometimes they're not warranted. But the important thing is, if they're asking for it to be too long, you need to get it shortened so you do have the right, if you decide, to walk away and go back to market. Number 3, this is a tough one. This is very hard to get, but we like to try to make the no shop mutual, okay? And so you can't make it perfectly mutual, right? Under your no shop as a seller, you're not going to be allowed to talk to any buyers. You're not going to get a buyer to promise not to talk to any sellers. So what we try to do is come up with a reasonable parameter around what they can't do. So if we're dealing with a small business that's local in nature, we'll say that they can't talk to any businesses in the same industry within a 200-mile radius during the exclusivity period, right? Or if it's a technology-based company that has a particular piece of technology that's going to fit into the buyer's overall view, we'll say that they can't talk to another company that offers that same piece of technology. Because when you don't have these clauses, it is unfortunate, but there are times where buyers sign letters of intent with the best of intentions, and particularly though if you've got a very high price, very high value in the letter of intent, they stumble 2 weeks later or a month later upon another seller who's not well represented and doesn't know what they're doing, selling at a discount to your price, and they say, well, we can buy this guy at 7 times or we can buy this guy at 4 times, and they walk away even though they've sunk some significant costs into the transaction with you. We see that happen. So trying to make the no shop mutual, it's very difficult and it's going to be limited in scope, but it's definitely worth a shot. Number 4, no acknowledgement of the seller's expectations. You can see how important this is. I think it's the 3rd time that I've mentioned it on the webinar here. The letter of intent should acknowledge what the seller expects in terms of post-closing involvement in the business, in terms of the amount of time that the buyers are going to take. I've discussed a few different aspects of expectations, but you want to get those expectations written into the letter of intent. They're not binding, but over the course of 4 months of exclusivity and trying to get a deal closed, people forget things. It's always nice to be able to go back and point out the letter of intent. Hey, we said in the letter of intent that we wanted this or that, and you're clearly not doing that. So maybe this isn't the right fit for us, or it is the right fit, but could you please conform to what we wrote into the letter of intent? And in order to preserve the goodwill, a lot of times buyers will bend to the seller's request like that. So it's important to write those expectations down. Communicate them across the table with one person from the buyer. That one person from the buyer is not the buyer. They may have heard it, they may have internalized it, they may be trying to carry it out, but the buyer may have 12 different employees plus all their advisors working on the transaction, and that message may not get from that one person that you as the business owner sat eye to eye with and told them your expectation. You put it in the letter of intent, it should make its rounds. Everybody on the buy side should know that it's part of the deal, or at least there's an expectation that it's part of the deal. Number 5, not disclosing a problem with the business. Yeah. So potential lawsuits, loss of a major client, loss of a salesperson, pending divorce, involving the owner. There are a lot of different things that clients try to hide from buyers, and eventually, by the time the deal gets closed, the buyer's going to know everything. There will be no secrets from the buyer. They will either find it in diligence, or they will write the purchase agreement in such a way that it forces the seller to disclose the issue. Or if it's a stock deal, the securities laws don't allow you to make material omissions that affect the value of the business. So even if you sneak through diligence, you sneak through the purchase agreement, and you don't tell them about something, and a huge lawsuit pops up 3 weeks later after the closing that you didn't tell them about, you're probably going to have some securities liability if it's a stock deal but not an asset deal. So the best thing is to get them on the table. So when we work with our clients, we always like to know the positive and the negative, and part of the marketing process is to sequence the release of the bad information, so that it doesn't get viewed as irrationally important to the buyer. And that's kind of true up to the letter of intent, to get them to sign the letter of intent. Then after the letter of intent, the thinking about the negative things is, every negative item you give them, no matter how large it is an invitation for them to lower the price. So you really have to have a hard think. If there's anything about the business they don't, and a negative thing about the business they don't know, probably a good idea to discuss it with them before the letter of intent. Why go under exclusivity for 2 months, then have them discover this issue, knock 30% off the purchase price, and then you go back to market from scratch. All your marketing materials are out of date. Everyone, well, not everyone, but people might find out that you had a busted deal, and they'll inquire into why it happened. Our view is it's really better to get those things on the table before you sign the letter of intent. Number 6, leaving the counterparty too much wiggle room. Boy, there's so many ways that that this can be done. What I'll leave it with is, read every sentence of the letter of intent and talk to your broker about every sentence of the letter of intent and figure out how much wiggle room each sentence creates and whether or not it would be realistic to try to narrow down that amount of wiggle room. And again, it's really every sentence of the letter of intent should be looked at on a standalone basis for this issue. Halfway through the 12, number 7, trying to get too much in the letter of intent. So there are times that we have clients that want to make the letter of intent look like the purchase agreement, and that is hard to do. It's just not the way deals get done. Buyers get fatigued. They don't want to deploy the kind of resources necessary to have those discussions at that early stage. They want to do their diligence before they commit, even in a non-binding way, to a lot of these terms that some sellers will try to get into the letter of intent. So again, this is why I showed the chronology of what's going to happen. The letter of intent is just a start. It's not an end. So there are a lot of things that just aren't necessary to get into letter of intent. Sometimes we see people try to cram long definitions. So a definition of net working capital, if there's an employment agreement, a definition of for cause termination, those things really should come later. They should, not only because you don't want to drive the buyer away, but also there's just a lot of things that when you get that level of detail and isolation, there's a lot of things around it that haven't been prepared yet. And so it can be misconstrued or lead to problems. So don't try to cram everything into the letter of intent. Number 8, not fully maximizing the price. I mentioned this earlier. Letters of intent can be heavily negotiated. The buyers will send them over. They'll have already signed the bottom, and they'll have a blank for the seller, and they'll send it as a PDF, as if it's a fait accompli, and your choice is to sign it or walk. That is never your choice. Your choice is always to get a Word version of it and mark it up and send it back to them. And in particular, with regard to the value, the price, right, that headline number, this is the time to negotiate that headline number, because though it's not binding, it's not going to go up. It may go down based on what they find in diligence, but it will not go up. So this is the time to negotiate that price up as high as it can go before you sign the letter of intent. Number 9, getting too many details. So this kind of ties back to number 7. We like to not have attorneys involved in the letter of intent, because if there's some issue that got into the letter of intent that the seller's not happy with later, it's always nice to have a lawyer come in later and say, well, I wasn't there when my client signed this letter of intent, so I know it's in the letter of intent, but my client's not going to agree to that being in the final terms. So what we like to stay away from in the letters of intent is a lot of legalese, because the lawyers and our clients often don't want to pay lawyers either to assist them with the letter of intent because it's early in the transaction. So we understand that. So it's nice to have the lawyers come in right after the letter of intent is signed. And some of the legalese I'm talking about is like the definition of net working capital or the definition of a for-cause termination. These are things the lawyers should be drafting in the definitive agreements. And we steer our clients away from anything in the letter of intent that's too legalistic. Of course, you have those couple of binding clauses, but they're straightforward and fairly simple. But we don't like to see our clients trying to get stuff in the letter of intent that really should be discussed with a lawyer beforehand. Number 10, covering the counterparty's fees. Sellers should not pay the buyer's fees. Sometimes the buyers will try to get the sellers to cover their fees or half their fees of this part or that part. They're the buyer. They're the people bringing the money. You're bringing the company. You're going to have your own expenses. Their expenses are going to be large by your standards. The cost of quality of earnings is probably far more than you expect it to be. So if you agree to pay half of the quality of earnings, you're probably going to get some sticker shock from that. So it's just not the right thing to do. It's a bad sign if a buyer doesn't have enough money to cover their own transaction fees. If they're asking the seller for some money, or we're talking, tens of thousands of dollars here usually. If they can't come up with the tens of thousands of dollars, one, can they come up with the millions? And two, how committed are they to the process? If they want to do the process with your money, there's probably a better buyer out there. So we are adamant in our view that our clients should not be paying buyers' fees, in part or in whole. Number 11, not fully understanding the counterparty's financing plan. So I mentioned that you should have the source of fund, use of fund in there. The number one reason that we see deals not closing between a letter of intent and closing is that the buyers don't have as much money as they thought they have, or can't get as much money as they thought they could get, is the better way to say that. And so before you make the commitment to go off the market and go through the process of due diligence, it's really fair for you to have a good understanding of their financing plan and to be able to talk to someone about whether or not that financing plan is realistic. So, that's not to say that if it's aggressive, you wouldn't sign the letter of intent and move ahead. We've had clients do that, but with the understanding that we may get through this process after a few months and it may fall apart because they're not going to be able to get the money. But you know what? The offer they made is so good, it's worth the shot. So you just want to, the point of this number 11 is not to rule people in and out as much as you want to make an informed decision about signing it. And this is an important piece of making that informed decision. Number 12, the final mistake that we see. And I kind of gave away all these points as we went through it, but not understanding that it is the end of the start and not the start of the end. We see, there's between the letter of intent being signed and the closing, lots of money, lots of time, lots of emotion, lots of stress, requirement for stamina. There's going to be moments of anger. Guaranteed there's going to be moments of anger between the letter of intent and the closing. Most of our clients have a very strong relationship with their business. They've been with the business for 20 or 30 years in most cases. Some of them say it's like seeing their daughter off to college. So it's an emotional experience. We understand that part of our process is built to help deal with that. And the really kind of, I think maybe signing an engagement letter is a little bit emotional, and then kind of going on the market's a little bit emotional. But boy, when you sign that letter of intent, that I see it in the faces of the clients. That's the first really emotional point, and there's going to be 50 more at least before you get to the closing. And the seller needs to be steeled away for this. They need to be ready for it. They need to know that it's going to happen. They need to be ready to commit that time and that emotional energy to getting the deal done. And so again, you have to understand that really it's a start to the process, not an end to the process. And that may be the most important thing to allow your LOI to end in a successful closing, is that understanding. So I left that one for last, even though I said these 12 weren't in any particular order. That one was saved for last. So that's it. We're running right on time here. I think it's time to take some questions. So Wade, have we got any questions in?
Yeah, we've got a few here. So when you were talking about the no shop clause, a question came up and it said, what is meant by, and I'm assuming this person has maybe seen an LOI before, negotiating in bad faith. So what is meant by negotiating in bad faith?
Yeah, okay. So in the law of most states and most countries, there's an implied obligation on the parties to carry out the purpose of the contract in good faith. And so in the United States, good faith means with honesty. It means it's different in different types of contracts. It's different in different states, but with honesty, with an intent to accomplish the purpose of the agreement. Those are probably the two things that are most important. So an example of bad faith would be a buyer that has you sign a letter of intent, agree to exclusivity, and then walks away. An example of bad faith from the seller side would be the diligence request comes in and the seller says, oh, I'm not going to provide half this information. Well, that's the way the process works. So there was an implied covenant to act in good faith when you signed, even though it's a non-binding promise to sell, the obligation to deal in good faith is binding on both parties. So you can potentially get sued for a non-binding letter of intent, not because you didn't sell the business, but because you signed it, the buyer hired all these people, the buyer sent the due diligence providers on site in accordance with an agreement you made with them that they could come in and look at things, and they show up and you say, I changed my mind, I don't want you stepping on my property today, and I know the price was $25 million, but I want $50 million. And you have all these diligence providers sitting in the parking lot, and you call the buyer and say, the deal's off unless you double the purchase price, and you can tell those people to go home. It's an extreme case, but that's where you're kind of getting into bad faith. So that obligation to act in good faith is binding in the United States and in many other countries, and it means to be honest and to act towards the fulfillment of the purpose of the agreement. It's really hard to get someone, I think, for a case for failure to act in good faith, but the allegations are made from time to time. It does happen. I don't see it with our clients, but we see it, in the press. You see occasionally some lawsuits out there where a non-binding LOI was signed and a buyer or a seller then didn't act in good faith. So it can happen, but it's a very standard that's very far out there. A buyer saying 25 million and saying, well, we had a case where a buyer said, well, I see that your email servers aren't backed up and your email server sits on the floor in a non-air condition. So we want to take, 10% off the purchase price. And it was a construction company. Like, really? Who cares about the IT system? I mean, the cost of making a good IT system, but don't take 10% off the purchase price. That wasn't bad faith. So that's the kind of headline of what that means. It's a good question, good faith. Yeah.
Perfect. I had another question here. At what stage does the contract become binding?
So the purchase agreement is what should be the binding obligation to sell and the binding obligation to purchase. The letter of intent, the letter of intent is only binding for those 4 or 5 clauses, and the minute the seller co-signs it, that's when those things become binding. But it's still your business, and you can still walk away from the deal. You can still go back to market. You can still change your mind and decide you don't want to sell the business right up until you sign the purchase agreement. So then when the purchase agreement is signed, they can be structured in 2 ways. Sometimes a purchase agreement is structured as a sign and close, where you sign it and close it at the same time. Other times they will sign and then have a period where some conditions precedent to closing have to be met. Maybe you have to go out and get consents for permits, or consents from the landlord, or consents from key customers on their contracts. And so there might be some conditions of closing. So you might sign it, and when you sign the purchase agreement, it's binding as soon as the conditions precedent to closing are met, and there will be a clause in there saying, everybody's going to use their best efforts to fulfill the conditions precedent to closing. So that takes that level of good faith one level even higher. But again, until you sign a purchase agreement, you can walk away from the deal.
Perfect, that's good. Steve asked, what are some of the factors that drive the EBITDA multiple that is being used in the LOI? I'm assuming also the purchase agreement.
Top four issues. I go to a lot of conferences with buyers and ask them, what are the four? If you could put in an evaluation based on only 4 pieces of information, what would it be? And so obviously no one's going to do it only on 4 pieces of information, but it's a thought exercise. So the top 4 are almost always revenue, margin, right? And when you put margin and revenue together, you can get EBITDA and profit, at least a close approximation, right? So margin, revenue, margin, growth. And the growth rate is not only just in the last year, what was the growth, but it's like, how consistent is the growth? If you grew 20% last year, but you sank 20% the year before, that's not as good as if you've been growing at, say, 7% a year for the last 5 years in a row, and it's always 7%. So growth and consistency of growth. And then the fourth issue that really plays on valuation that kind of surprises people is customer concentration. And customer concentration doesn't just mean, oh, we have one customer that's 30% of our revenue. The concentration can also be an industry. So if all of your customers are in new home construction, that can have an effect. It can also be geographic. So if all of your customers are in, Venezuela, for example, it's an extreme example, but that can be a form of customer. So customer concentration in all of its iterations. Another example would be kind of, pharmacy software. We sold a bunch of those businesses. So they may be dealing with pharmacies all over the country, but if they only deal with pharmacies that have between 2 and 5 stores, that's a form of concentration. So buyers will look for every potential type of concentration because they're trying to identify risk. So those are the 4 key issues that buyers say. Now, what goes beyond that is that what also matters is the fit for that buyer, right? There's a reason they want to buy the business. There's really not just people sitting around with tons of money that say, that looks like a good business, I'll buy it. They have to have some kind of plan for the business, particularly if you run a good process and they're the person that's coming out on the top of the pile. The reason they're offering more money than everyone else is because they have some unique need for that business. And so that's part of why signing a letter of intent before you have phone calls, before you have face-to-face meetings is not a good idea, because just like the buyer wants to learn about the business, in order for the seller to agree to a headline price, the seller should really know why the buyer wants to buy this particular business. Why did this buyer outbid all the rest of the buyers? So this counterparty here thinks the business is worth more than everyone else. Why? And if you can get to the bottom of that, oftentimes you can unlock additional value and go back to that mistake number 3 or 4, which is not getting maximum price. So if you as a seller don't understand how the buyer valued your business, you're probably not getting the maximum value for the business. So I talked about the 4 or 5 main reasons that all buyers use, but the 6th reason is the reason you got to figure out, and you got to get in there with that buyer, figure out why they're the person putting in this great offer, or else you're leaving money on the table every single day of the week.
Okay, that's good. I have another question that I think is pretty good because I've seen this in the past. Do you ever work on deals where the seller is insisting some type of good faith deposit? If so, do you amend the LOI to include it? And if so, when?
Yeah, so this is something that we didn't see. We didn't really see this until the last year or two. It started popping up occasionally. And it was more so the buyers offering the good faith deposit as opposed to the seller demanding it. It's not common for sellers to demand it. If a seller demands it, it's very unlikely that a buyer will make it, because as I mentioned earlier with like the sale of a house, right? So this concept might be coming from houses, right? Where a house is a house, and if you pass the inspection, you got to buy the house. And maybe there's 1 or 2 contingencies, but buying a business has thousands of contingencies. And so it's really hard to say, here are the circumstances where you're going to keep the money, and here's the circumstances when I get the money back. And oftentimes, and we actually had a deal this year where we tried to draft an agreement for an escrow and say, all right, what are the conditions when the money goes to X or the money goes to Y? And the process was so time consuming. It took more time to negotiate that than the whole letter of intent. And at the end of the day, the parties couldn't come to an agreement on what it meant to have an earnest deposit. So they're really not of much value in most cases. They are of, if the buyer offers it, it's like it's probably the best you can get. That's a nice gesture. I appreciate that. It shows your seriousness, but don't worry about it. Let's move on, because it's just a quagmire that you get into. That said, we did have a client that made a lot of money off of deposits. But what happened, where it came up was exclusivity ran out, and the client said, and this is where we see sellers asking for it most often, exclusivity is up. You said you needed 120 days. 120 days is gone. You're not there yet. So why should I give you more time? Well, I'm so serious, I'll give you some money. That's where we see them kind of make sense. And when they give that money, it's pretty much gone. It's not, I get it back if such and such happens. If you'll extend exclusivity for a month, I'll give you X $1,000. That's really the only time we see earnest money or any type of prepayment deposit really making a lot of sense. All right, so that takes us to the end of time. I know we have some more questions, so we'll write back to the people that wrote in. Hopefully we got email addresses or something for everybody. So we will write back to everyone, and we hope to see you next month for whatever our listeners or viewers tell us they want to hear about next month. Okay, thank you for joining us.